Thank you for tuning in and welcome back, team. In today's episode of Real Estate Investing, we continue with our real estate guide with part 5, real estate financing. My name is Andrew Finney, your real estate geek. If you need help finding a top agent where you live, or if you simply want to drop me a line to say hello, my contact info is below. If you haven't already done so, please go ahead and subscribe to this channel now and like this video. Okay, team, let's talk about this. You know, in the last episode, we were talking about finding investment properties, and it was really exciting. And in today's episode, you're going to learn 11 different types of financing for your real estate endeavors as it pertains to your investment career. So let's go ahead and kick off on it with what you need to know about understanding first what real estate financing is. So obviously in real estate financing in episode 3, we were actually talking about different kinds of property to invest in. Now we're going to talk about the different types of financing you can get to and invest in those properties, whether you're looking at single family homes, commercial homes, apartments, or just there's land. There's so many different kinds of ways. And we talked about some strategies too in the same episode, episode 3, about buying and holding, flipping and wholesaling. So let's talk about this. You know, if you're really going to be looking at getting real estate financing for your real estate investing career, what you want to do is make a strong partnership with a local loan officer. You want to understand what kind of loan tools they have available and how they can benefit you in your career, so that you know how to leverage your capital, you know how to minimize your risk, and how to maximize your gain. Now, one thing to note real quick before we start getting into the different types of financing is when you hear about the no money down, I just want to be very clear. Is it possible to go into real estate investing with no money out of pocket? Yes, it is, in the short answer. The longer answer is it's a lot more complex. So there are a lot of strategies that investors use to invest in real estate and without having a lot of cash, and some are better than others. But it's one that you need to know what you're doing, and you're in the right place right now to help you make that decision. What I'm going to do is, you know, one of my favorite places to go to find information about real estate investing is actually biggerpockets.com. So on biggerpockets.com, they actually have a free ebook you can download. I'm going to put the link below so that you can go ahead and download that book if you want to know more about how to invest with no money or low money down for your real estate investing career. Okay, so go ahead and take a look at that if you like. It's in the show more description below. The first way that you can get into real estate investing with financing your property, obviously, is all cash. So with all cash, it's kind of interesting to note this. Sometimes people think that it's like, oh, okay, you're really going to bring over $100,000 in cash and you're going to drop it down to the title office. And it's not the case. You're normally writing either a personal check or cashier's check. You're wiring the money into the title company. There's no real money being exchanged here. It's all on paper. And that's how this goes down. So a lot of investors, in fact, probably a good chunk of them, you know, a third or more of them are going to be cash investors that are out there that will buy all cash. So there's different trade-offs to buying all cash. But let's go ahead and go into, before we go into the trade-off of buying all cash, let's talk about buying all cash. If you have $100,000 to invest, right, and you chose to buy $100,000 of a property, and let's say that property produced roughly $1,000 a month of income, or essentially $12,000 a year, that means you've got a 12% return on investment. Now remember that analogy as we move into the second type of financing, which is conventional mortgages. So with conventional mortgages, you know, if we know that our 12% return with all cash, if we invest all $100,000, we did not leverage that money, right? So with $100,000 all into that one property, the only way to get it back is to re-leverage that money. You're getting a 12% return, which is a heck of a great return, but can you do better? I think that you can. So if you were to do a financing, let's say that you same $100,000, right? And you were able to get a 20% down conventional loan. That means that you could buy 5 properties for the same amount of money that you bought one. Now let's say that you were earning a little bit of money off of that. So if you were earning, let's say, the same amount of money, let's say that you were clearing about $300 a month profit on each one. If you cleared $300 a month on each one of those, then guess what happened? You're getting now $1,500 a month, over $18,000 a year with the conventional loan product that we're talking about in this example, which is an 18% return on the same $100,000. So you essentially doubled your return by just leveraging your assets and your capital. Now, whether that's a good decision for you or not, that goes into your risk assessment and what your goals with your real estate investing career are. And everything that you do, please be sure that you're comfortable and confident with every decision you make, whether you choose to buy out all cash or if you choose to explore financing options to help you leverage your capital and be able to build your real estate portfolio up from there. Now that brings us to the third type of financing, which is actually a portfolio lender. Now portfolio lenders can be pretty interesting because when you think of like conventional mortgages or FHA mortgages or different type of mortgages in general, right, you're generally thinking of like banks, mortgage banks, credit unions, and those are great places to start. And they have the capital to fund the loan, right? But there's also another type that some banks have. Not all banks or credit unions have them, but they do have what's called portfolio lending. And they don't really advertise this. So if you want to know if your bank or financial institution has portfolio lending, then go ahead and reach out to them and ask them. Because they don't really like to advertise it, but if they do have it, the biggest difference between a loan and a portfolio loan is that is the bank's actual money that they're extending to you from the portfolio loan, and the terms are going to be a little bit different. But if they want to extend it to you, they can, with essentially just a quick review of your situation and your intention behind it, and they can issue you a portfolio loan. Ask them. See how it plays out into your options with your real estate investing career. Now, the fourth type of financing. This one is fun. This one's the FHA loan. And you're probably thinking, hold up, Andrew, I heard FHA is a federally insured loan for owner occupants only. You're absolutely correct. It is a federally insured loan, and yes, it is for owner occupants. So you might be wondering, well, how am I going to use this for investing then? And that's a great question. The way that you would use it for investing is there's a nice little exception in the FHA guidelines that say that you can buy a duplex, a triplex, or a fourplex, right? A quadplex, right? As long as you live in at least one of the units as a primary owner, you can rent out the other. So now let's think if you have that same $100,000, right? And you rent out and bought a fourplex. And let's say that you can rent out each unit for $350 a month, right? That means that you could clear $1,050 a month while you live in one of the units and you rent out the other three. You just paid your mortgage, and now you're starting to generate wealth for yourself by virtue of getting into it. Now, whether buying a fourplex, a duplex, or triplex is right for you, only you can answer that question. Just know that the FHA loan can make it a reality, opposed to like a conventional mortgage where they're generally going to be looking for 20% to 30% for investment options as a down payment amount. The FHA is currently at a 3.5% down payment. So it saves you a huge amount of money on your down payment, and it'll help you build up your equity stake faster. It'll help you build up your real estate investing career quicker, and it's going to give you your first experience in being a landlord and also with an investment property that you can keep for many, many, many years to come if you start with this method. That's something that I would certainly encourage you to do, especially if you're at a position in your life where you can do that. It might be a really, really good idea to strongly consider your first home being a fourplex or a duplex or a quadplex if it makes sense for you. Think about that, because it's something that could really help you build up your real estate investing career and help you always have a passive income in your life. The fifth one is actually a 203K loan. Now, a 203K loan is what it's a subset of the FHA loan, first of all. But when people think 203K loan, it's like a renovation loan. And that's what it's there for. So it's there for you to be able to buy a property and roll the cost of the renovations into the actual FHA loan itself. They do work a little bit different, but they give you a down and dirty of how it would look. Let's go back to our $100,000 property, right? Let's say you bought a triplex for $100,000 and a couple units need some carpet and paint, and you need to go ahead and get that done, and it's going to cost about $12,000. Well, once you get that approved by the bank to do that project, they'll actually take that $12,000, roll it into the $100,000 they gave you to buy your triplex, and then you're still going to only pay 3.5% down. So you just financed the renovation at 3.5% to get yourself into that property, start renting out the other two units, and live in the one that you're going to be living in to be in compliance with the FHA loan. So essentially you pay like $3,920 to get into your first investment property. Now that goes back to when we were talking about an overview and we mentioned no money down or low money down. That's a low money down option that can start generating for you right away by taking advantage of an FHA loan to get yourself a duplex, triplex, or quadplex. Again, think about that. It's a great idea if it works out for your life and where you are in life and your situation right now. The sixth financing option is actually owner financing. Now, owner financing is kind of interesting. So owner financing works one of two ways. The first way, and the most pristine and clean way of doing it, means that the person that's selling the property owns the property free and clear. In other words, they don't have any debt on it, right? They just pay the property taxes and maintain the property, and that's it. So they have the ability to give you that property on an agreement that you're going to pay them back. So they can finance you. They would play the bank, right? There'd be no bank involved. They would actually, the seller in this case is the bank, and you guys work out an agreement. Now, a lot of those will also come with terms in it that say that if you default on a payment more than 2 or 3 months, right, they can take the property back from you. So it depends on the terms that you agreed to. Now, as in all real estate contracts, whether it's real estate investing or if you're just buying a primary house for yourself, if you feel like you don't completely understand the contract, then it's probably best not to sign it until you consult with a trusted real estate advisor, or if you're curious about specific terms, perhaps a real estate attorney might be more appropriate. If you're going to pursue the owner financing route for your investment property, I would highly encourage you and strongly suggest that you get in touch with a real estate attorney to help you make sense of that and make sure that you're not going out on a limb there and putting yourself in a bad position and in the future. Make sure that you get that double check, okay? So it's really interesting how that can work. Now, that brings us to the 7th point. The 7th financing type is actually hard money. I'm sure that by now you've probably heard of hard money and private money, and you're probably wondering what the difference is. We'll get to private money in the 8th type, but for now let's talk about hard money, and let's give you 9 different ways that you can identify the characteristics of the way that hard money behaves, okay? A hard money, the biggest things that you're going to notice as a defining characteristic is that the loan is primarily based on the value of the property. So it's not based on anything really other than the value of the property itself. They come with shorter terms. Generally, the terms can range from as little as 6 months to about 36 months. They do have a higher than normal interest rate, normally double to triple or quadruple the market rate. So if the market's at like 6 percentage points for mortgages, then you could expect 12 or 18% on a hard money loan. They also have high loan points, which is the fees that they're going to charge you to actually get the hard money loan. And many hard money loan lenders actually do not require income verification, which can make it easy for a lot of different people. They're not going to check your credit references, and they're not going to show up on your credit report. Hard money can often be used to fund a deal in just a handful of days, and since it's hard money, it's the same thing as writing an offer cash. Even though you're borrowing the money, you're borrowing it from a hard money lender, which means they're going to give you the cash once you guys come to terms and agreement of how much that capital is really going to cost you. Hard money lenders, as a 9th characteristic here, will understand when a property needs rehab work and work with you on that. But it is important to note that it could be beneficial for short-term situations if you know in fact that you're going to be able to add enough value to that property and sell it before those the 6 months goes into 36 months. Because since you are paying a higher interest rate, it's very important to take stock of your numbers and what your monthly cash flow is going to look like. The cost to renovate if you're flipping the property is really the only time you'd really want to do this. Because if you're unless the market was over 18% or 20% interest for a loan, it wouldn't make a lot of sense to use this for a rental income property. It would make a lot of sense if you're going to be flipping and it's your way of getting started into the flipping world, but you need to be very, very clear on what that money is going to cost you. As you know by now, nobody's going to give you anything for free, and everything comes with a price. Make sure you're not paying more of a price than you can afford, or this with outside of your comfort level. Make sure that you keep everything within your comfort level as you explore the financing options, okay? So that brings us back around to private money, which is the 8th type of financing here, private money. So private money is very similar to hard money in a lot of ways, but the big defining characteristic of it is the relationship between the lender and the borrower. A lot of times private money could be your friend, it could be your family member, it could be your aunt, it could be your uncle, it could be someone you went to college with, essentially somebody that you know. And the relationship is going to be a lot different with the private money, because even there might be a close relationship with the private money lender ahead of time, maybe not, but again, it's very common that it is. Because of that personal relationship, they may be a little bit less business oriented, and the thought process as far as lending you the money, they might just want to try to help out. But private lenders will lend you cash to buy a property in exchange for a specific interest rate. Maybe like going back to hard money. Let's say that the going rate for hard money for your circumstance, a hard money lender told you they'll give you the loan for 12%. But maybe your friend who has done well for themselves and has money and wants to invest it says, hey, I'll loan you the same money, but I'll only charge you 9% interest. So you're going to save 3% interest points, and you're still going to have the cash to move on with your plans, right? So then they'd be looking for a specific return on that money. So they're generally not looking at getting into the monthly cash flow and taking money from that, but they do want their money paid in full at a specified term. Since it is somebody that you may already know, or a friend of a friend essentially, right? Then the terms on these can actually range from 6 to 30 years. It just depends. It all depends on the relationship of the person with the private money that's giving it to you. Again, when you go in to write an offer with private money, then you're just submitting a proof of funds and you're essentially writing cash as the buyer, even though you have an agreement worked out for you between that person that is the private money lender and yourself. Again, if you have any questions about that, it's really good to probably have a real estate attorney involved, even if it is a friend, just to make sure that it keeps everybody honest and keeps everybody on the same sheet of page of music as you move forward, and it doesn't damage the friendship in the future if something didn't work out quite right, okay? So the ninth way, and this is very commonly used, by the way, the ninth way is a home equity line of credit, or just simply a line of credit. It's very commonly used because if you already own a home, right, and you have equity built up over time in your property, and you say, hey, I want to get into real estate investing, where can I go to get access to my capital? I know I have maybe $100,000 of excess money in my home, so that would be a home equity line of credit that you would be looking at applying for there. So if you were using a home equity line of credit, often referred to as simply a HELOC, or a home equity installment loan, which is an HEIL, right, a HEAL, then you have the opportunity to do that. Let me give you like a real world example of this, because a lot of lending institutions out there will give you up to what's like a 90% loan to value ratio on your home in a home equity line of credit or a home equity installment loan. So what's that mean? Let's break it down to easy math here. If you have a $100,000 home, and let's say that you owe $50,000 on it, right? If you owe $50,000 on that $100,000 loan, then that means that you have $50,000 of equity. If you can only get up to 90% loan to value ratio of a home equity line of credit, then what that means is that you can go from 50 and you can take out 40, and then you owe $90,000 now on your primary residence, or 90, which is 90% of the $100,000 that you have in your home, right? So that's how that works. You just simply take your home value, multiply it by 0.9 or 90%, if you will, and then that's your maximum loan to value ratio in a lot of cases with a home equity line of credit and home equity installment loans, okay? So let's show you how this kind of works if we give you a real world example, and we'll keep the math simple. So let's say that your current home is worth $100,000, and you visit your favorite institution, maybe your credit union or your local bank. And when you did that, they told you, hey, we'll give you up to 90% loan to value on your house, and you owe $50,000 on that house on the first mortgage. Well, the home equity line of credit is going to act like a second mortgage that you're borrowing against, and that means that they'll give you up to $40,000 to invest into your new property. Now, with the $40,000, obviously, you could then go out and buy one or two other $100,000 properties, which now you've successfully leveraged the money into your real estate investing practice and starting to get yourself going. Now, if you're just getting started going and this is a method you're going to do, then you might want to consider just doing one property first to get your experience underneath you, and you don't bite off more than you could chew at one time. I would just caution you to use a little bit of restraint and wisdom and logic here, and not biting off 2 or 3 properties, because if you listen to a real estate seminar, you watch some of the YouTube videos and got really, really pumped up and really super excited, and you started having this dream board of what you want to do, and you wanted to go out and buy all these different properties. Well, if you've never owned properties, if you've never flipped properties, and you never have been own rental properties before, then you don't have the experience just yet. You may have made some of the partnerships that can help you with experience, but it's best to get the organic experience yourself before you go out and adding to your portfolio. Start with one and slowly grow. If you're starting with one and growing, then your pace is sustainable and you're getting educated along the way and gaining insights into the process. Then maybe a few months down the road or a year or two down the road, you can go back and add maybe 1 or 2 more properties to your portfolio. But by building up at a pace that you're comfortable with, you're going to build a sustainable future for yourself, and you're going to be able to better achieve the goal that you have. One of the many goals that people have about getting into real estate investing to begin with is that passive income and financial freedom, right? So plan it out smart, and you'll be able to do that. Now, the 10th way is, and we touched about on this one in episode 4, but the 10th way of financing is partnerships, pulling in a group of like-minded friends, like-minded business partners, or what have you, family members that want to become investors, pooling the resources. Now, whenever you do this kind of a partnership, it changes a little bit. So let's say that everybody's contributing $25,000 in this example. Let's just say that you're buying a $100,000 property. Everybody's going to go even Stevens, and everybody's giving up $25,000 into that property, right? Well, what that means now is your profit, your cash flow in that is likely going to be divided by 4 depending on what you guys agree upon. Again, anything and everything can be done. It just depends on what you guys agree to in writing in a contract. And that's why I keep mentioning you might want, again, highly encouraging it, if this is your circumstance, to use a real estate attorney to keep everybody honest and everybody clear on the same sheet of music, so everything's explained, everyone knows their responsibility, everyone knows the risk and reward in the process. But it is one of those ways that you can do that. So it just depends on how it ends up playing out. You know, maybe the property appreciates to a certain level you guys are predefined. Maybe that $100,000 property doubles and it goes to $200,000. Everybody cashes out. Everyone got the original $25,000 back plus their $25,000 profit when it cashed out. Or maybe everybody puts money into this $100,000 property and it's being rented out at $1,000 a month, let's say, and everybody gets $250 a month profit, right? Or $250 a month income from that investment. Now, if that's the case, just keep in mind that you want to leave room for your maintenance of that property and any renovations that may be done to it in future. So you want to obviously not kick out all $250 to each partner. That goes back to what you guys agreed to in writing up front, of maybe 20% being put aside every single month for the rental property in question. So it just depends on how you're doing this, whether you're flipping, whether you're renting, or what your goals are here, okay? Now, the next way of doing this, the 11th way of financing property, actually goes into commercial loans. So when we're talking about commercial loans, they're quite a bit different. What we were talking about before now, in the last 10, are commonly used with residential property. So when we start talking about commercial loans, it's a whole different animal altogether with commercial lenders. You know, their interest rates are going to be higher, the requirements are going to be higher, the boundaries of entry are going to be greater, and so they're going to take a look at your financial position, whether you're earning $20,000 a year, $300,000 a year. They're going to take a look at that. But what their bigger concern is the property itself that you want to invest. If you're talking about like a $10 million apartment structure, right? They're going to be more curious about not only how are you going to pay them back, right? So that's why they're going to review your financial situation and your personal side, but they're more interested is, what's your business plan for this apartment complex that's going to cost $10 million? Is it going to be able to generate enough revenue to be able to pay them back? If so, then perhaps they'll give you the loan. So it's more based on how much potential revenue generation can come from the property, as opposed to how much money that you may actually earn yourself when it pertains to the commercial loan. But again, to find out more information about commercial loans and how they work, it's really best to go talk to a local commercial loan officer and explore the options that they have available and see if that's going to be something that you want to do. Now, that's going to bring us full circle in this video when we start looking at maybe other investment vehicles or other investment tools that you may have at your disposal. I'm not going to go into it. The list can get exhaustive, so I'm going to just keep it really brief here. So with this point, you could consider things about borrowing against life insurance. You could look at borrowing against Roth IRAs, borrowing against a 401k, cashing out some stock, or doing a collateral trade. So there's different things that might be available to you. Now, a financial advisor may be able to better assist you with understanding how your financial investments can tie into real estate investing. If that's your circumstance, if that's your case, then talk to your financial advisor and see if that's something that you want to do. So this has been a video today about real estate financing. We've gone through the different ways of financing pretty quick. So if you have some questions, just let me know. I'll go ahead and pop up my contact information right now, so that if you want to drop me a line and say hello, or you have a suggestion for another video or something, let me know. I always love to hear from you. Now it's your turn. Tell me what the one thing was that was most significant in this video that you're going to take away and use today in your real estate investing career. Please share it with us in the comment section below. Thank you. If you haven't already done so, I'm going to ask you to do 3 things. Number 1, please subscribe to this video. Number 2, please like this video. Number 3, please share this video around with someone you know is going to be able to help. And thank you so much for sticking in there with me today, team, and watching this video. In between now and next time, I'm wishing you all the love, wealth, abundance, and happiness in the world. Enjoy a terrific day, and we'll see you again soon.